Now that we understand how to measure the initial cost of inventory when we purchase it and which cost flow assumption to apply to record cost of goods sold when we sell it, we need to consider valuation issues that might arise down the road. What if the inventory we have left is no longer worth what we paid for it? For example, when Apple comes out with a new iPhone, the value of the old iPhone inventory might eventually be less than its initial cost. Assets should never be reported at more than their value to the company. When inventory's recoverable value drops below cost, GAAP requires write-downs. This lecture covers the two approaches used to determine what that write-down might be: the lower of cost or net realizable value approach and the lower of cost or market approach. What causes inventory to become worth less than what we paid for it? Obsolescence, technology advances, consumer preferences shift, new models replace old ones, last year's phone is out of fashion, sits in inventory while current versions sell at full price, physical deterioration, perishable goods spoil, electronics corrode, merchandise is damaged in storage or in transit, declining market prices, commodity prices fall, or competitors' prices below your cost basis, making your inventory worth less in the market than what you paid for it. When any of these occur, the carrying value of inventory may overstate what the company will actually receive when it sells these goods. GAAP's response is grounded in conservatism. Recognize the loss now. Do not wait to book the loss when you eventually sell the goods at a lower price. Write it down immediately in the period that the impairment is identified. Net realizable value is defined as the estimated selling price in the ordinary course of business minus the estimated costs of completion and disposal. NRV is the amount the company actually expects to walk away with after selling the item. As an example, let's take an item that costs $90. You can sell it for $85, but it's going to cost $5 to prepare and ship. So NRV is $85 minus the $5 shipping, so $80. Because NRV of $80 is less than the cost of $90, we need to write the item down to $80. The journal entry for the write-down involves a debit to cost of goods sold or inventory write-down expense and a credit to inventory. The effect, inventory on the balance sheet is reduced and a loss is recognized on the current period's income statement. Under US GAAP, the write-down's permanent. You cannot write the inventory back up, even if its value is later recovered. This second approach compares cost of inventory to its market value. This approach applies to US GAAP companies that use LIFO. The key complexity under lower of cost or market is not defined as the selling price. Instead, market means replacement cost, what it would cost today to buy or reproduce that same unit of inventory. But replacement cost is constrained by two boundaries. The ceiling, the market cannot exceed NRV. If replacement cost is higher than what you can sell the item for, net of completion costs, use NRV as the ceiling. The floor, market cannot fall below NRV minus a normal profit margin. This prevents writing inventory down so far that selling it would produce an abnormally high profit, which would distort future income. The designated market value is replacement cost, but only if it falls between the floor and the ceiling. If replacement cost exceeds the ceiling, use the ceiling. If it falls below the floor, use the floor. Final comparison, if designated market is lower than cost, write down to designated market. If cost is lower, no adjustment. Key takeaways. When inventory value falls below cost, GAAP requires an immediate write-down. Be conservative. Recognize losses now, not later. There are two approaches that compare cost of inventory to net realizable value for companies using FIFO or weighted average methods, or to market value for companies using LIFO. US GAAP write-downs are permanent. IFRS reversals are permitted when values recover. In the in-class exercises, you're going to work through both approaches. For lower of cost or net realizable value, the key is computing net realizable value correctly. For lower of cost or market, work through the ceiling floor analysis carefully before comparing to cost. Getting the designated market value right is the core challenge.